What if your child never had to catch up financially because you started now? Or better yet, what if you could give a child years of wealth building before they ever start their first career? Today you can open and fund investment accounts for kids like a custodial brokerage account, Roth IRAs for kids, 529 savings and investment account, and more. And the truth is, it's never too early to start. But before we talk about accounts, you need to understand why starting early matters. If you invest just $100 a month and earn a 7% annual return, starting at birth, that money can grow to over $800,000 by age 65. Starting at age 25, it grows to around $240,000. Same investment, same return. The only difference is time. That's why investing for kids isn't about complexity, it's about structure. And the right structure starts with the right account. So whether it's your child, grandchild, or another family member, here are 6 of the best investment account options to help kids get started, how they work, who they're for, and how to use them effectively. A custodial brokerage account is an investment account opened by an adult on behalf of a minor. The adult manages the account and makes all investment decisions until the child reaches the age of majority, usually 18 or 21, depending on state law, at which point control automatically transfers to the child. There are 2 common versions of these accounts. UGMA accounts are limited to financial assets like stocks, ETFs, bonds, and cash. UTMA accounts allow those same investments, but may also hold additional types of property, depending on the state. There's no federal limit on how much you can contribute to a custodial account. However, contributions above the annual federal gift exclusion may require filing a gift tax return. Most people won't owe any gift tax because of the lifetime exemption, but the reporting requirement still applies. Any minor can have a custodial brokerage account, as long as an adult is designated to serve as the custodian. A custodial Roth IRA functions just like a regular Roth IRA, but it's open for a minor with earned income and managed by a parent or guardian until the child reaches adulthood and takes full control of the account. Contributions are made with after-tax money, the investments grow tax-free, and qualified withdrawals are completely tax-free. Contributions, not earnings, can be withdrawn at any time. Investment growth is generally reserved for retirement, but it can also be accessed for certain qualified purposes, such as a first home purchase or higher education expenses. For 2025, contributions are limited to up to $7,000 or the child's earned income, whichever is lower. The key requirement is that the child must have earned income. This can come from things like babysitting, lawn care, part-time work, or legitimate wages from a family-owned business. A 529 savings and investing account is a tax-advantaged investment account designed specifically for education. The money grows tax-free, and withdrawals are also tax-free when used for qualified education expenses like tuition, books, and room and board. Most plans offer curated investment options, including age-based or target date portfolios that automatically reduce risk as the child approaches college age. Depending on where you live, you may also receive a state tax deduction or credit for contribution. There are 2 main ways these accounts are structured. The more common option is a college savings plan, which offers flexibility in how the money can be used across eligible education expenses. Some states also offer prepaid tuition plans, which allow families to lock in today's tuition rates at participating schools by paying part or all of the cost in advance. There's no federal annual contribution limit for a 529 plan, but each state sets a lifetime maximum balance. Contributions are treated as gifts, which means larger contributions may require gift tax reporting. One unique feature of 529 plans is that you can front-load contributions by funding up to 5 years' worth at once, as long as it's reported properly for tax purposes. And anyone can open a 529 account on behalf of a beneficiary. Stock trading accounts for kids are designed specifically to help teens learn how trading works. These accounts let teens place trades while parents keep oversight. Depending on the brokerage, teens, usually between 13 and 17, may manage the account themselves with parental monitoring. Once they turn 18, the account typically converts into a standard brokerage account. Some firms like Fidelity, Charles Schwab, offer youth accounts built exactly for this purpose. And for kids who want to learn without risking real money, paper trading accounts are a great option. They simulate real market conditions using virtual funds, so kids can practice safely. Most of these accounts are built for learning, not for holding large balances, and they typically don't come with strict contribution limits. The exact features and rules can vary by provider. Enable or Achieving a Better Life Experience account is a special type of 529A account that allows individuals with disabilities to save money in wages without losing access to public benefits. The account is owned by the person with a disability, not a parent or guardian, and family and friends can contribute. The money grows tax-free and can be used for qualified expenses like housing, education, transportation, and healthcare. These accounts are offered through state-sponsored plans, and features can vary by state. For 2025, the annual contribution limit is $19,000. If the beneficiary is working and not contributing to an employer-sponsored retirement plan, They may be able to contribute an additional $15,060, with some states allowing higher total limits. To qualify, the disability must have begun before age 26, with that age increasing to 46 starting in 2026. Eligibility may be based on Social Security benefits or specific medical criteria. The ABLE National Resource Center is a helpful resource for confirming eligibility, comparing state plans, and understanding how ABLE accounts interact with public benefits. A special needs trust is another way to provide financial support for someone with a disability without affecting eligibility for income-based government benefits. The trust is managed by a trustee and is commonly funded by parents, guardians, or other family members, often using assets the beneficiary will inherit. In some cases, the trust can also be funded with the beneficiary's own assets. There are a few common structures. Some trusts are funded by third parties, others are funded using the beneficiary's own assets, and pooled trusts combine resources from multiple beneficiaries while keeping accounts separate. The right setup depends on where the money comes from and how distributions need to be handled. There are generally no contribution limits for special needs trusts, but there are costs involved in setting them up and maintaining them over time. Start by identifying the goal. If the child has earned income, a Roth IRA may be an option. If education is the priority, a 529 plan may make sense. If neither applies, a custodial brokerage account is often the default. If a disability is involved, consider an ABLE account or a special needs trust. Next, choose a broker that offers no account fees, no minimum deposits, commission-free trades, and support for custodial or youth accounts. These features make it easier to start investing with small amounts. Most accounts can be opened online in under 15 minutes. You'll typically need basic information for both the adult and the child. After funding the account, help your child decide what to invest in, keeping the focus on simple, long-term choices. Starting early doesn't require a lot of money. It requires the right structure and consistency. When you choose the right account and involve kids in the process, you're not just building wealth, you're building real financial understanding over time. If there's a specific account you want me to break down step by step how to set it up and how to use it, let me know in the comments. I always read them. And if you found this helpful, consider subscribing for more weekly analysis. A quick like or share goes a long way in supporting the channel. I'll see you in the next one.